Up next, our last panel for the day. The FarmDoc team, the rest of the FarmDoc team is here, the last panel. Gary Schnitkey is with us, along with Scott Irwin, Nick Paulson, and of course, Jonathan Coppess. I'm going to let each of them talk for 3 to 5 minutes on their subject area. Do you want to do, so they're on, have you two divided this up? I didn't ask. Are you going to do crop insurance and farm management, or what do you want to do?
You start, Gary.
Gary's going to start. Gary's going to start. Are you starting with, you start, you pick your topic.
All right. So I get to pick my topic. Well, let's just go over what we think about risk management. I'll cover briefly crop insurance and ARC PLC, and Nick will do farm incomes and something like that. All right. So crop insurance. Most of you have taken, pretty high coverage levels of RP in the past several years. I would probably stay there. That's a good place to be. And one of the things that I would think about is sort of staying in the 80 to 85% coverage level range. And the reason why I say that is because if you remember ERP back in 2022, it topped up crop insurance to 95%. Well, I would estimate that the $21 billion in ad hoc disaster assistance will top up in an ERP-like program in 23 and 24. And we don't have any clue about 2025, but I would guess that there's going to be the same program again. So stay in that 80 to 85% coverage level. I would consider strongly ECO, particularly after this last couple tariffs. Consider it. It's not a slam dunk, but ECO goes from 90 to 95% down to 86%. The premium will be less this year. And again, that 95% coverage level is in 90% will kick in sooner. Again, think about that. The caveat to that is if we have the ERP, you're sort of washing out your payments, but who knows if you get that ERP like in 2025. And then for commodity title programs, ARC County strong lean on all three. Soybeans in particular, but followed by corn and wheat. The only thing that you might not think about, or the only reason to do PLC is two. One, you really think prices are going to be down, and prices being down would be below 340, 360 market year average for corn. That seems kind of low. So think strong lean for ARC County. The other reason, if you take ARC County, you preclude SCO, but I think ARC County's probably the one you want because it's free. So I'll stop there.
Me? All right. So, I mean, the story we've been telling on the farm income outlook situation has been pretty consistently depressing now for about 6 months. I think back to August of 2020 quite a bit because I remember that being the month we released 2021 crop budgets, and it was sort of a sky is falling story at the time. And then about 2 months later, we looked extremely stupid because the corn soybean markets started what ended up being basically a 18-month rally where the best time to sell corn and beans was always tomorrow. And we've just been in the opposite type of situation now for the last 2 years, a little bit of life in the corn market more recently, but both corn and beans have just kind of consistently grinded their way down. Coming off the high incomes in 2020 and even more so in 2021 and even more so in 2022, we saw production costs adjust up. So that's kind of been another big theme of what we've been talking about in the management side of things on FarmDoc in the last 6 months. And that's, I mean, those high production costs, historically, we don't see a lot of downward adjustment. that is achieved on the production cost side. Our markets are very responsive. We can see price movements both up and down relatively quickly, but those costs are much harder to get back down once they've gotten up into certain ranges. So the support payments, I think, were mentioned a lot today, and Bruce talked a lot about the shift in recent years towards going back more and relying on ad hoc payments. Maybe our current ARC PLC programs aren't designed to address some of the financial challenges that we faced in the last few years. I find all of that to be a little problematic and concerning moving forward, because it's almost like we're getting Band-Aid solutions every year to problems that are much more systematic and severe. Where markets are trading and where we would still argue that longer term prices are at just simply don't really make sense with where production cost levels are. And if we continue to get support payments that continue to keep those production costs high and don't force some of those adjustments, we're just kicking the can down the road year after year. So on the price side, I'm going to credit Scott and Daryl Good, who back in 2006, 2007, they did some work where they sort of projected where the new era of corn and soybean prices would be because of the ethanol boom and export market development and expansion in China on the soybean side. And looking back, they pretty much nailed the trading ranges and those new longer term averages. And again, where those longer term averages are, markets are a little bit below maybe where those long term averages are at, but they're still very much in line with the trading range we should expect. And again, production costs are just out of line with those longer term averages. They may have worked with $5+ corn, $14 beans in 2022, but it just doesn't work at mid or low $4 corn, and mid $10 or even $11 beans is pretty tough at the cost levels that we have. So I kept the good vibes going today. Thought I was going to sound more optimistic after the soybean panel, but I think I failed at that. So
Apparently. That's all right. Shall we talk about policy next?
Doesn't want to. I tried to get him.
Yeah, I can be real brief. I don't know.
Biofuels.
You're a tough act to follow, Coppess. Okay, well, I'm in the unusual situation of being the optimist on the group. So I'm going to start on ethanol, Todd, and I'm going to list from my most optimistic to least optimistic drivers in the ethanol space. The number one most optimistic factor for ethanol is the one that is being least discussed right now. And that is the Trump administration is going to slow down the adoption curve for electrical vehicles in the United States. It's a long, complicated topic, but I'll put it this way. Well, start with the EV adoption has started. It's going to continue, but it's going to take decades, not years. Think of the benefit of a change in a whole suite of policies under really the last 16 years that were designed to speed up the adoption of EVs. We are clearly going to pull back substantially on those incentives. And what is it worth to the U.S. corn ethanol industry and corn producers if you put off peak gasoline use 5 or 10 years? That's what I believe is going to happen as a result of the changes to incentivize EV adoption in the Trump 2.0. That is going to be worth billions of gallons of annual ethanol use between now and 2030 and into the mid 2030s. We're still going to lose some demand from EV adoption over that time frame, but it's not going to be nearly as severe as you would have projected just 3 months ago. So that's number one most positive factor for corn ethanol. The second is ethanol exports, largely driven by climate policies in other countries. Our number one ethanol export from the United States is, guess where, on Tariff Tuesday? Canada. They're taking 40% of our corn ethanol exports, which in 2024 look to be just shy of 2 billion gallons. Now, Canada has made a jump from basically E5 to E10, probably some growth, but big growth there is probably over. But it's a big part of our corn ethanol exports, which are in that 2 billion gallon range. And we have another couple of potential big markets that have announced policy changes. Number one is Japan. Japan could easily be over 1 billion gallon a year ethanol market in total. The U.S. won't get all of that. And so I expect robust growth in U.S. corn ethanol exports to Japan if they follow through on their plans. And it won't be immediately, but it will happen. And then the third down the list is E15. It's interesting. That's all that the corn ethanol and corn people want to talk about is E15, but it's been growing agonizingly slow. We're just always around the corner of, it's going to just take off next year. Well, then next year it's going to just take off. The RVP waiver that everybody talks about, I believe that is going to happen in the new Congress, and it will give E15 more of a fighting chance moving forward. But I think for a variety of reasons that I could talk about in the Q&A if you want, I still think that the growth in E15, even with that year-round passage, is going to be slow. So, but at least it's still positive if that gets passed, but it's not nearly as important as 1 and 2. So that's ethanol. Moving now down to biomass-based diesel, which is FAME biodiesel and renewable diesel. I'll kind of just go with Jonathan. I have no idea. Actually, there is, for the people thinking about the soybean market and the soybean oil market, it would take me more time than I want to take to explain, but there's a situation developing where I think we could have a very surprising pop in the soybean oil market in the second half of 2025, as we finally have to get serious about meeting the RFS mandates for FAME and renewable diesel. But I'll leave it at that. Obviously, also tremendous uncertainty related to which feedstocks. Basically right now, that sector is kind of seized up because of the tax credit purgatory that we're currently in. But people are overgeneralizing that. That cannot last. Soon, in a few months, the market will have to incentivize the meeting of those mandates. Last thing I'll talk about is SAF. I think it's on life support. I'll end there, Todd.
I have a follow-up question for you, which is, and I asked this question of, I don't remember, somebody in AFB in November, a couple of guys that should have known, related to E12 versus E15. And why, when 12% has already been approved to be used in all cars 2000 and newer, they push 15 as opposed to just E12. And I think there's also, does E15 has to be blended in a blender pump, right?
Right. E12.
But
has-
E12 would not. E12 could just go into the regular system.
They
They looked at me rather knowingly, and it was either, man, that's a stupid question, or there's something that I don't know about.
What is on the books from the EPA, E15 is approved for use in all vehicles 2001 and older in the United States.
Newer, you mean?
Newer, excuse me.
Yeah.
2001 and newer. There was a move towards potentially E12, I don't remember, sometime around 10 years ago, but the corn ethanol industry didn't get behind it, and some thought that that could be consistent with existing Clean Air Act regulations, but it's in kind of a legal gray area, is
Okay.
what I would say. Keep the focus on E15.
Okay, so on the question side, you've got to ask questions because I have 2 6-packs to give away and 8 FarmDoc Ace College of Ace hats. So I have to have at least 10 questions out there from you. You can start asking those when you
Are
want.
you really going to let Jonathan get away with absolutely nothing?
No, I'm coming to. No, that's why I turned my back on them, as I want Jonathan to actually lay out what he thinks.
I still don't know.
Ad hoc versus. How about this? What are the possibilities of a farm bill being done this year? Maybe that's a short answer.
It's not going to happen this year.
Okay.
So,
And-
I mean,
and-
let me put this in a little bit of context before I get in trouble.
Okay.
With with my colleagues. You've seen in the news, Congress is now going to be consumed by budget reconciliation, and if you don't know what that is, you can thank your sanity for not knowing what that means. In effect, it's going to take over the whole kind of legislative process for the next however many months. And tucked into that are instructions to the committees, like the agricultural committees, to cut spending in their jurisdiction. The House Budget Committee's reconciliation instruction is for $230 billion reduction for the House Agriculture Committee. That's out of the Farm Bill that presumably is almost all SNAP, the Supplemental Nutrition Assistance Program. But it's that process that's going to consume Congress for the foreseeable future. Makes it really hard to imagine that a farm bill has any chance to squeeze in anywhere. Certainly not during that time frame. After that, we're well down the road to start a farm bill process, which I think brings back to what a lot of people were saying throughout the day. This ad hoc assistance, that $10 billion is on its way out the door probably within the next month. And that's really become the farm program. At this point in time, ARC and PLC, I think Nick was probably too nice about it. ARC and PLC are looking more and more like failed programs, failed policy, and we're just throwing in ad hoc spending. If you're putting these two together, the irony might cause you to fall off your chair because the budget reconciliation process is cutting spending. At the same time, the ad hoc system is adding spending, but we don't count that because it's off budget. So it doesn't count in all the budget scoring, which might be why we're, at whatever debt level we're at $2 trillion in deficit annually. So you can see where this is headed, but it's not headed towards a farm bill.
Just a note on that, the EA program, which is now named something else, ECAP.
ECAP. is the new
ECAP.
name. E/CAP.
And Nick
Dash
estimated the payments on that to be $43 per planted acre for corn and 30 each for soybeans and wheat. Take 85% of that, or $35 to $25 probably this month per planted acre, plus 50% on prevent plant acres, and that should be. Actually, if you read the Secretary's press release, you will get the application by the March 20th deadline. So we'll see about that. But it does sound like that is coming, and obviously that will be a big deal, right?
So we had that discussion this morning. So there is an application that you have to sign for this?
According to,
Yeah.
according to the secretary at the Commodity Classic meeting, what they're doing is pre-filling the application. So everybody reports their planted acres, right? 578 form to FSA. So they're going to pre-fill those out if you've already turned in your acres, so they have it on file and send it back out. Now, having once worked at that wonderful agency, I would strongly encourage you to thank your FSA employees.
Yeah, I
That
was
is
gonna
an
say.
enormous amount of work that they're going to be doing on your behalf to fill out your report, send it to you, you sign it, send it back, checks in the mail, or electronically dropped into the bank account. So it is a much more automated process. Obviously, at the same time, we're watching massive cuts in federal employment and agencies, so be nice would be my suggestion, because I think they're going to be stretched pretty thin to get this done. But it is set up to be more automated than probably what you've seen in the past. It will be filled out, sent to you, signed, sent back. Kind of
Good
thing.
news, they're holding off the ARC PLC decision until April, so they get a little more time.
The other thing is there's $21 billion of disaster assistance, which I think will be a ERP extension into 23, 24, which they've done it so many years, they'll do it again. So be on the lookout for that, which if you've had a crop insurance payment in 23, 24, that will top it up. So that could be another cash flow.
Now, when you were saying the yields, is that their 24 crop that was harvested in fall of 24 yields that the FSA office needs?
No, they need acres.
You've already reported acres. It's the 2024
Just acres.
planted.
Okay.
Yeah, it's just acres.
You said something about yields at the end of it. Maybe Gary did.
That would be if they take the emergency relief program and write it for 23, 24, then all of that would flow from your crop insurance, and you would get another application. So
Hey, wait a minute. Save one of them.
what?
The six-pack. The one thing, we're gonna have to wrestle for that last one. The one thing I would add, and
What?
I think you're probably
You wanted
right.
this
There's
beer? Is that
a
what-
general ERP. The one caveat I might tack onto that is the priority for that damage will be the Hurricane Helene destruction that went through North Carolina and parts of Georgia. So my guess is they prioritize that, and then there'll be something around an ERP top up for a lot of the other long list of natural disasters that they covered for 23 and
Did you
24.
want the beer? Fine, the farmdoc team's really good to me, so I'm going to give that to them. And Wayne went and got
I'm
Sue
driving.
and took her back, so he got the other six-pack. So you're only down to this. All right, what is your question here?
Will the sudden price of
My personal view is I agree with you that it might temper it, but it's like a tempering from 94.5 to 94. Maybe a few 100,000 acres in total. I think those plans are pretty much largely set at this point. That's my view.
So that question was whether, about expansion of corn acres, yes.
So the price of insurance, will it go up, being we dropped so much in price this last 3 days or whatever?
So
The price.
Is that a volatility question on crop insurance?
Well, I mean, we got the projected prices are $470 for corn and $1054 for soybeans. That's based on February average settlements in February for the D's corn and November bean contracts. 470 is 4 cents higher than last year's projected price, so that would tend to increase premiums a bit just because your guarantees are higher and your premium as a percentage of your insured liability. But the volatility factor is sort of working in the opposite direction on corn. We'd expect your corn premiums for same product you bought last year, same coverage level, to be very similar to what they were last year. On soybeans, premiums will be lower. That projected price is $1 off of what the projected price was last year. So, and the volatility factor on that bean price that affects premiums is also down. So, bean premiums should be lower for the same thing you bought last year. Corn should be, I think, pretty similar, right, Gary?
yeah, that's what I would. Yeah.
So that being said about the crop insurance, the ECO policy on top is up to 9%, but it can be bought by the percent, right? Is there a sweet spot? Like, is it 3%? Is it 5%? Is it all 9? Do you guys have any thoughts on that?
So you can buy from 85 to 86 and also 90 to, so you got two coverage level options. 95 or 90 both go down to 86%. Personally, I would take the 95 because that triggers earlier. Then you have to make a decision about a protection level. And 100%, you're still going to see premiums of $17 for corn. But you can lower the premium by lowering the protection level. So if you lower the premium 10%, you'll also lower the payments when they happen 10%. So it's sort of whatever you want to pay.
Margin protection insurance from 24, what kind of money we expect, and then same for this year, or 25 if we already signed up for it.
24. Do you know?
I don't follow margin protection.
You stumped the ag economist.
We don't know. 25.
They don't know.
You know, honestly, the cost part of it was probably about a wash between in both those years. So it'll be based on whether if you bought it at 90%. It'll be tough to trigger both years, I would guess. Maybe I don't.
Okay, I'm going to go back to what we were talking about earlier on the payments. Are double crop beans going to be included under the wheat payment, or are they a separate payment, or has that been disclosed anywhere? Because I've not found it yet.
On EA, I don't.
On ECAP.
Yeah.
Yeah.
We've not, I mean, I think, unless you have, I think we're in the same boat. We don't have any specifics on how they treat it.
The guys that are
Um,
doing the recording for me.
Some's going to depend on the county, right? If you're double cropped, if you're in a double crop county where they count it as a planted acre, but I haven't seen anything specific on it, so I don't know.
We've asked too and not gotten answers.
No.
No, it's not you.
It's not you.
Other questions? So the question is, what happens to the bean meal if we begin to really crush for oil?
Right. Unless we see really even more robust growth in livestock numbers in the U.S., it has to go to export.
Export market.
In essence, you dump it into the export market.
This is a question we've asked a couple of times on the air, particularly when we're talking to Frayne Olson out of North Dakota State, because so much is railed to the northwest, and so many of their soybeans are going, and they also have crushing capacity there. The problem, again, is infrastructure, both at the port, which I think they have built out for bean meal loading, but rail too. So you have to have both. You have to have the infrastructure the whole way, and that's more difficult. And meal's not easy to transport, apparently. Other questions? Yeah.
Scott mentioned SAF is on life support. Could you explain that a little bit?
Why is SAF on life support?
Well, first off, I don't think in my professional career I've seen quite as big of a difference in the ag sector between headlines and reality. SAF is, there's almost none of it actually produced in the United States, a couple dozen million gallons in a sea of jet fuel of about 25 billion gallons. So it's extremely small to start with. So it's just not going to take off quickly because it's starting so small. That's number one. Number two, even with the stack of policy incentives that are in place for SAF right now, at least in theory, it's questionable that that's enough to really incentivize large-scale major investment in SAF production facilities. And then what you have to deal with right now is the likelihood of the new Trump administration really pulling the rug out from underneath the tax incentives that questionably incentivize the industry. Specifically, if 45Z goes away, which currently is my expectation, that's just a death knell for SAF. It cannot make it without that subsidy.
Is it only a domestic death knell? Do you have the same opinion on the world or global stage as it's related to sustainable aviation fuel?
I think that actually allows me to get a little bit on my soapbox for ag in the long run. The bottom line is Europe has a very small mandate, 2% starting this year for SAF on flights that land in and out of Europe or the EU countries. The U.S. is relying on basically tax incentives. And until we mandate SAF, like we have originally ethanol and biomass-based diesel in the form of FAME and RD, I don't think that industry is ever going to really get off the ground. And I think that if you're looking for something new, innovative, that is in very much the long run, let's look 15, 20, 30 years down the road, the most important policy development that crop agriculture should push is the expansion of the RFS to jet fuel and sustainable aviation fuel as a separate part. Right now, sustainable aviation fuel earns RIN credits under the RFS, so it can contribute to meeting the mandates, but there is no mandate for SAF.
Oh, rather than just being part of the advanced biofuels, you think it should have its own an actual mandate?
And I think because in the long run, the EVs are going to win and ethanol is going to lose that market in the very long run. Now, that might be 20, 30 years down the road, but the only real market I can see to replace that demand loss in the long run is SAF. And I think the only way to make sure that happens and get that industry kickstarted is through a mandate.
Ethanol got its start 30-some years ago because it was a higher oxygenate without the cancer causing the MTBE. We don't hear anything about that anymore. Is there another alternative to ethanol, or does it have to be mandated? I guess if people really believe that this is the only thing we have that can increase the oxygen,
that's a broader issue. That has to do with the octane value, is what you're talking about. And that's one of the great untold stories. In fact, I have a seminar I'm giving in our home department over at the U of I on exactly that topic, which is, the story is the RFS kind of kickstarted the investment in the ethanol plants, and then somewhat begrudgingly, the crude oil industry figured out, well, if it's going to be made, it turns out it's actually the cheapest source of octane that we have. And so up to 10%, the way I would put it, you could remove the RFS tomorrow. Just imagine a world where it just went away. I don't believe we would use 1 gallon less ethanol in E10 in the United States because it is by far and away the cheapest source of octane in that E10 blend. The competitors, there's a number of competitors in from petroleum feedstock sources. They're mainly called the aromatics. There are some others, but they're just much more expensive to produce, and then the aromatics have some nasty cancer-causing problems that also make them less attractive. So, that's a very positive market story for corn ethanol in the United States. It is firmly entrenched in E10. Not as much when we talk about E15, because the additional octane that you get, about an additional point, thus the E88 campaign, isn't in a sense needed, because 87 octane is regular gasoline in the United States. And so for the gasoline refiners to take advantage of E15, they'd have to completely re-optimize their petroleum feedstocks again, and that's really costly. And to get just an additional point of octane, the analysis I've seen says that they won't. But maybe this is something that could be more wind behind the sails for E15 is the octane story, then I might have given it credit. We'll have to see, because one of the things that's been most interesting to me in studying over all these years the ethanol and biofuels market is learning how complicated the chemical cocktail we call gasoline is. It's just not one thing, and it can be the composition changed depending on the price and availability of different kinds of petroleum feedstocks and biofuels. So, but overall, it's a very positive story, and it has some real profound implications.
How do you build markets for new agricultural products, or what's the best way?
Well, there's a long history, others may comment, of trying to start all sorts of new agricultural markets. I think probably ones I'm most familiar with would be biofuels, and they've gotten their start with policy incentives. Basically, they're subsidized to get started. And ethanol and E10 is a great success story because it really has left the infant industry protections and can stand on its own. But that would be, and there's probably others that I'm not thinking of.
Soybeans in the United States.
Right. That happened in the 30s and 40s.
In the 30s, put a tariff on what? Manchurian soybean oil, if I remember correctly, so that they could press it at Tate and Lyle. Ray Staley at the time. Any other questions? I have one last one. Yeah? Okay.
Isn't E30 actually superior to the other blends?
Is E30 superior to other blends?
That depends on who you talk to.
Further out west, I've heard a lot of people advocating E30 a lot better.
Okay.
E30 has the advantage of, you're getting a very high octane premium fuel mixed with 84, if you're mixing it with 84 octane. If the blend is 84 octane petroleum and then something like 115 to 118 octane ethanol, in a 30%, 70% mixture, you've got a really high octane premium fuel that you can then, in theory, better, more efficiently run really high compression engines. But we really aren't set up to do that right now. And so, I think that's the argument, but I don't think that it's going to get very far because everybody is thinking about really long-term investments in the surface transportation area, staring down the barrel of the EV transition. So are we really going to go through and make massive investments to move towards all high compression, turbocharged internal combustion engines when you can see 20 years down the road what's going to be happening? So I understand the argument, but I don't think it's going to happen.
But is it,
Let,
is it total EV though, with the pipe dream really?
What?
Total EV, isn't that really a pipe dream?
oh,
Well, that's I don't believe it. No, I think that it will proceed, and I guess here's my answer.
the question is whether our EV is a
name
pipe
me
dream.
an area in our modern economy where digital technology has not ultimately won. Name one.
How about rather than total EV, more EVs in the automobile industry?
I'm going to make it
than
50
gasoline
years from
engines.
now, there will be no internal combustion engines.
There you go.
Now, but it's going to take a lot of decades and a lot more technological development. Today, we cannot do that, and we cannot do it with reasonable cost with our present electrical generation capacity, the capacity of the grid, the range of the vehicles, issues with batteries and safety. There's a whole menu of technological problems with EV technology that's going to have to be overcome. But I believe they are a superior consumer product, and they will win in the long run.
You don't own one though, right? Me either, and I'm with him. I think.
Well, actually, I do, Todd.
Oh, you do.
But it's not, and it's not really even a technicality. I own a hybrid, which is a form.
Oh, you do
of
own a hybrid.
Is a
Okay, yeah.
form of an electrical
Yeah.
vehicle, and in fact, over the next decade, hybrids are much more of a threat to
Oh.
corn ethanol demand.
Yeah, just
than
buy a hybrid.
Battery
They're
electric
great vehicles. Just buy a hybrid. They're
Basically, a Toyota's
Yeah.
versus a Tesla. You know, you should be worried much more about the Toyota.
And I don't
hybrids.
own a hybrid at the moment either, but just we've driven them on campus for such a long time. It's since the early 2000s, and they usually tend to be fantastic vehicles.
Was that strong enough of an end point for you, Todd?
So-
No, it's not. I've got
It's
one.
not yet?
Yet not wanted it to be, but I got one more question.
No, just let me, you
Oh.
know, honestly, whether you want to debate that or not, if you're looking out, it's difficult to see growth in corn and soybean demand, right? I mean, just look out and say, tell me what it is, and we can more easily list things that cause it to come down than go up. And then remember, there's Brazil. And even if we do increase it, there's Brazil. So, and I don't say that to be negative, but to say that you better get used to 430 corn and 1040 soybeans.
But that was actually my last question.
That's why we need an SAF mandate.
Yeah, there you go. So my last question was actually to see.
I mean,
so
that's only
you were at
one.
430 corn and what?
So I'll go 430 corn, 1040 soybeans, and it could be 450 corn. I don't care what it is, but at those price levels, our cost structure is not built for that right now. And as long as we keep getting economic assistance, we won't go back there, right? And so we're sort of stuck here. So that's
Well,
what
that's
we're
a
at.
bad circle, right? Economic assistance and low prices.
I got one question then. The elephant in the room here seems to be input.
Yep.
It's gotta
That-
change. So
that
it's
was-
rents, that's inputs, that's agribusiness. They don't change, so what is producers?
Related to the answer he just gave you.
Yeah, so you look, I don't see seed coming down, and I don't see fuel coming down, and I don't see pesticides coming down, and machinery isn't coming down, and the only thing that's sort of left is cash rents, and and you're not going to lower them until you have to, right? Yeah, so you won't, and then what you're hoping for is that 3 years from now, we have a drought or someplace, and you get a price spike, and it all kind of works for a while.
And the economic assistance you put back into the inputs, which keeps them from coming down, which was.
So that's not all. I'm not trying to, but the thing that I notice now versus in 2005 is just the larger losses that you take on cash rent farmland when you're at the prices we're at. You're taking larger losses on cash rent farmland. If you own land, you're okay because you're sort of letting your own land cover your cash rent land because you're not paying that $350 cash rent, right? So that's sort of the conundrum that you face right now. I think farmland prices are going to hold in there just fine, but you got to look at what those returns are on that cash rent. Look at your operation and see if you have a high cash rent farm, what it's actually adding to the financial stability of your farm.
So last question, and I guess, Jonathan, you probably don't need to answer this question, but of the three that are dealing with the supply and demand tables, your projections at the moment, I don't want you to talk about those relatively speaking, other than, do you think you will have to project season's average cash price higher or lower as we go through this marketing year when you change the budgets?
Not sure I understand the question.
If we updated our crop budgets today,
When-
what would we use for prices?
No, when you get to June and August and September, do you think you will have to update them higher or lower? I don't.
The prices?
Yeah.
Well, it'll depend on where the markets are at then, but I mean, so our last budget update was in January, and if we had done it 2 weeks later, it would have looked different. But right now, I don't even know if I'd change our crop budget prices. We had a little bit of a rally in corn, but that's sort of been wiped out in the last week. It's somewhere in the low $4 range and somewhere in the low $10 range. And I don't think anything has changed that, Gary. I don't know if you.
You tell me what Trump's going to do for the next 3
I'm
months.
suggesting what I wanted you to do was to tell me. You didn't need to tell me the reason why, but which direction it was going to go is my question. But that's okay.
Oh, well, that's a different question.
Yeah.
Well, what?
Don't know.
Don't know.
No, I mean,
Yeah.
uncertainty in that respect is off the charts because there's just so much, the trade uncertainty could be removed in a few weeks, and then the grain markets will rally again, and it will also be a function of the weather. I probably lean outside of the trade thing, which is very unpredictable, slightly positive on grain prices because of what I see in biofuels, and I just think that early signs of bad weather and drought concern me for the summer.
On that note, rather than the EV note, we will finish. Thank you much. Give these guys a nice round of applause. Thank you for sticking around for the day. We do appreciate it. Have a good trip home.